In this video, we're going to look at trading drills, always in the market drill. Stay tuned. Hey traders, a very warm welcome to you. Okay, so in this trading drills series, we're going to look at another trading drill that proprietary traders teach their trainees, and that is to be always in the market. So pretty much it is exactly as it sounds. Rather than let's assume we're day trading, and again we could kind of use this for swing trading as well, we'll talk about that in a second, but assume we're day trading and we have a trading session in front of us. We're trading the DAX throughout the day, we're trading bunds, we're trading whatever it may be. The idea of this drill is you always have to have a position. You cannot not have a position. It's either long or it's short. You're not out of it. Now, in theory, you're thinking this sounds crazy. However, there is some reasons this, and there's always an underlying reason why you're doing this drill. The idea of this is there's multiple reasons why this benefit you. The first thing is you've got to make a decision what you're going to do. Now, maybe first thing in the morning, you put yourself in long or short. Now, that's immediately giving yourself a slight bias and forcing you to do your overnight analysis. You look at the overnight action, you look at the sentiment at the open, you're kind of saying, hey, I've got to be open straight away. As soon as that bell goes, I've got to make a decision. And so you're going to spend a lot of time putting effort into what you expect to happen first thing off the open. Now, you might say, hey, at the open, I kind of expect us to open, drive down, and then we'll have a trend day higher. And so you will think, you know what, I'm not going to get short because I don't want to try and flip to long. I don't want to be trying clever about it. I want to make the most money possible, so I'm going to get long. So this is also stretching the muscles of saying, hey, go with the bigger bias. If I think it's going to be a good bullish day, the obvious thing for me to do straight off the open is to get long. I'm not going to try and get cute and clever and try and scalp this little bit, because I'm going to say, hey, I want to stay on the long side. If I change my thesis, I'll flip. But it's going to need a lot to change, because really I've already decided I'm long based on previous market action. Maybe we're in an uptrend, we've closed up, we're going to gap up, it all looks nice and strong, we've got resistance way above us, blah, 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 all this decision-making process we make to do that, you're going to get long. Now, of course, when we're in a trade, imagine we're in for the first hour or so and things are going well or not, you've got to make the decision. There's two decisions to make. It's either do I stay in or do I get out? That's it. Or do I go, oh, I flip it and get short? I can't get out, I have to flip it. And so you think about how much extra decision making you need to go from long to short. It's very easy for us guys, and you know, we've probably all been there, I know I have, and trying to stretch that decision and say, hey, do I want to run this trade? Do I want to run this trade? And it's an easy decision to make, to say, you know, I'll just take my profits. I'll just take my profits, because there's no real consequences to that in this short term of taking your profits, right? If you're up £1,000, $1,000, whatever it is, there's no consequences and there's no drawbacks to taking that 1,000. Now, we all know that over the longer term, that might be detrimental for us, because we want to try to stretch that to 2,000, 3,000. The trade could run for us if we're constantly taking small amounts of money, whether that is 1,000 or 100 or 10 or 10,000, doesn't really matter. The point is, if we're constantly taking that small amount, we know that over time that might not be beneficial for us, but in the short term, there's no loss to it, right? However, if we're doing this drill and we have to flip to short, suddenly the decision is different, because there are short-term consequences to that. It might be the easy decision to take £1,000 and say, that's a great morning for me. But if you have to make the decision between, hey, I'm up 1,000 now, do I go short? If I'm wrong and it carries on without me, I could lose that. Do I stay with it? And if it goes, it's a much more carefully calculated decision, which means you're going to have to not take that decision lightly, not just go, I'll just take the profit, which many of us do. Many of us just take that decision very lightly to take a profit. A profit's a profit, and we don't think about the long-term value or detriment of doing that. So it forces you to say, hey, well, actually, you know what, maybe we are a little bit overbought here and this, and we might pull back a bit, but ultimately I still think we're bullish, I'm going to stay long. Or you might say, hey, you know what, this is really stretched now, I want to get short and I don't mind being short. So it's also going to help you with that decision-making muscle of, you know, making putting a lot of weight on the exit decision when you're in profit. And it's also going to highlight a lot of things. It's going to highlight, are you closing your trades too soon? Are you running your trades as much as you should? is there a pattern here where, hey, you're really good at reading the market, but you're flipping things too early? Because this is going to force you to obviously be in a position. And if you say, hey, well, listen, my P&L was kind of doing this, it was up, then it was moving down a bit, then it was moving back up again. And this period here was where I just called the market not quite right. I had the kind of structure of it right. I was just a little bit early. You do this drill regularly on a demo or on a very small trading size, you might highlight that and say, well, actually, look, it's obvious now when I'm forced to always be in a position, it shows that I'm often a little bit too early to the turn, and I need to kind of restructure my strategy. I need to restructure my plan, my setups to allow for this. And perhaps, you know, in my real trading, I use a limit to kind of go a little bit later. Or if I do the drill, next time I'm going to try and improve by holding on for a little bit more, maybe another 20 ticks, another 50 ticks, whatever market you're trading, to try and stretch you and highlight the problem. So, you know, and the obvious thing is if I'm just constantly losing, and I'm constantly losing all the time, and I'm losing every day by always being in the market, you can reverse engineer that. You can say, listen, what decision making am I doing? It takes the kind of, obviously if you're over trading or in out, you need to say, listen, I need to make a commitment here. I don't want to flip it 4 or 5 times, and perhaps you can add that parameter into the deal if you want. But it's also going to highlight, hey, if I'm always wrong here, why can't I reverse engineer what I'm thinking? I'm thinking that this has gone too far and ultimately goes further. So how can I restructure that with my trading? How can I make a plan out of that and kind of reverse engineer my thoughts to make myself some money? So that's the day trading perspective of it. Swing trading, similar, not quite as kind of useful for you because you've got to hold it over a long period of time. More for day trading, but I guess you could kind of try it out on a shorter term basis with swing trading, but you're going to take a longer amount of time to get any meaningful data from it. Whereas day trading, you can run this drill every day for kind of 5 to 10 days, get a really good amount of data, stretch that decision making muscle, write the journal, see how it felt, see how it, you know, kind of get all your data, extrapolate it over the actual chart, and you will be in a much better position to make you know, adjustments to your trading plan, your strategy, and your mindset after the 10 days of this drill than from just regardless, just pushing on blindly and losing and not making any progress. So one to try, guys. Let me know how you get on in the comment section below if you do this on a demo. If you do it live, just obviously be cautious of the risk management and the usual kind of disclaimers apply with that. But if you do it on a demo, it's not a bad way of doing it. Always in the market drill. Let me know how you get on. I'd be interested to hear if you did it. All right, guys. See you next one. Take care. Bye-bye.